Good evening, ladies and gentlemen. My name is Baso from the University of Johannesburg Center for Africa-China Studies. Thank you very much for joining us on this online seminar. So we'll be beginning shortly on this evening's proceedings on the theme of how is COVID-19 affecting Africa, particularly to be focused on the continent's economic futures and the role of development finance institutions in this regard. And so I'm honored now to introduce our chair for this evening's proceedings, Professor Sarup Sinha, the Deputy Vice Chancellor for Research and Internationalization at the University of Johannesburg. Over to you, Prof.
Thanks very much, Basa, and good evening, everybody, to join us this evening for this seminar. We highly appreciate your interest and generosity, particularly of our two speakers, who will be taking us through this theme. Basa introduced the theme earlier. The theme is how is COVID-19 affecting Africa, the economic futures, and the role of development finance. Colleagues and friends, in the outbreak of COVID-19, no region has been left untouched, and this will likely be a long-term effect. Recent studies show, however, that Africa, which had already had economic and developmental challenges, will particularly be vulnerable. But even here, global financial projections indicate that we should expect the various economic effects to be uneven across the different regions in our continent, with ramifications including recessions, further debt and unemployment in countries that were already grappling with these. At the same time, others are also on the cusp of solving their own developmental puzzles. How does this pandemic affect those cases? Regarding this, today's webinar is meant to spark a discussion on the continent's prospects, hopefully touching on regional and continental approaches, as well as leveraging external relationships that the continent has. I also hope that this discussion will be solutions-oriented, and I'm equally hopeful that the speakers and those in attendance will identify some silver linings, so to speak, in terms of potential opportunities that are presented given the magnitude and unprecedented nature of this crisis. In these aims, we are fortunate to be led by Hannah Rieder, who will be our leading speaker, with her discussion being around the theme of Africa's response to COVID-19. How can we minimize the impact on poverty? We'll then take the time to listen to the work that is being undertaken by one of the continent's key development finance institutions, the Trade and Development Bank, as ably represented here by Mr. Masoud Tadesi. We will then open up the discussion with questions and comments from the audience. I'm going to introduce Hannah Rieder, who is our first speaker. Ms. Rieder is the CEO of Development Reimagined, a groundbreaking international development consultancy headquartered in Beijing, in China. She is an economist, and former diplomat, and has close to 20 years of experience, including as head of policy and partnerships for the United Nations Development Program in China. So with that introduction, I'm going to turn over to Hannah.
Okay, good evening, everyone from Asia, which is a few hours ahead of you. So my apologies if I'm a little bit slow this evening, but hopefully we'll be able to have a good discussion and also an excellent Q&A session afterwards. So what I'm going to do now is share a presentation first of all. As Professor Sinha suggested, the title of my presentation is really around how to minimize the impact on poverty of COVID-19 through African responses. I'm going to begin by providing a bit of a timeline just to give you a bit of context as to how COVID-19 came into Africa in the first place, So as you know, the first COVID-19 case was recorded around December 2019 in Wuhan in China. Over that period, over the next month or so, the US recorded its first case, Italy recorded its first case, and Egypt was the first African country to record a case of COVID-19 on February the 14th, a Chinese national. Thereafter, the numbers of cases, Egypt was actually the 25th country in the world to record a COVID-19 case at that point. And by now, we know that the cases have spread all across the continent. Now, some countries, and I'm going to come into this a bit later, some countries were faster than others to act. So, for example, I show there's two examples there of Cabo Verde that closed they imposed some travel restrictions even before they got a COVID-19 case, and that was the same for Uganda as well. But nevertheless, those countries do still have cases and are still having to deal with the problems just as much as others. I think it's important to put into context, and when we're thinking about how does COVID-19 affect the economy, the way to think about it is that it's a twin threat to economic growth. So first of all, the majority of countries have tried to close their borders, suspend international flights, shut down the country to others, so that effectively COVID-19 is not imported from elsewhere. The second type of action is the closure within countries of marketplaces, even of full lockdowns where people are just kept at home. Those two very physical actions create their own implications, and very distinct implications for economic growth, and therefore for poverty reduction and poverty levels in our African countries. I'm going to give you a bit of an example of the first implication. So this is because of the suspension of flights and suspension of trade, effectively tourism, these external effects, what kind of impact do they have? So, and as an example, I have here two graphs which show the relationship between African countries and China in terms of trade. And what's interesting about these graphs, and the reason why my consultancy and my team looked at this kind of data, was obviously China was the first place where COVID-19 shock was felt. And therefore the question was, what are the reverberations going to be around the world, and what will be the reverberations around into African countries? And bringing up a point which I will repeat several times today, and I'm sure in our Q&A, there is not one country which is going to be affected the same as the others. We have 55 African countries, and each of them has its own very unique relationship with the rest of the world. So with respect to the effects of the trade relationship with China, remember that there is one side where African countries may be exporting all of those, exporting a number of goods to China, in particular oil, commodities, agricultural goods. And there we identified in this red square, as you might be able to see here, identified a number of countries that are vulnerable to that effect. The ones that have the strongest relationship and rely on that relationship with China, on sending those exports to China for their for their exports and for their GDP. On the other side, on the right-hand side, you see the African countries' vulnerability to a supply-side shock. So meaning they usually get that it looks at their dependency on China in terms of what sorts of imports they get. And of course, we know that many African countries don't just export to China, they import quite a lot of goods, especially higher value goods. And so we found a number of different countries which were vulnerable, but vulnerable in very different ways. And that is an effect that whatever a government does, there's very little that they can control. And that kind of analysis is also possible. I'm not going to share it with you today because it's too detailed, but one can also do that kind of analysis for tourism, also obviously for other countries, other markets beyond China, European, US, and so on. So this kind of analysis helps a government or even others in country, organizations in country, to predict, look, what is our vulnerability, what is our risk at this stage at different parts of our economy. So moving on to the second type of effect of this, the second aspect of the twin threat, there is the internal poverty impact. So this is from the decisions that different governments take depending on their view of how strong they should shut down, how early they should shut down economic activity, which has been one of the key required responses to COVID-19. COVID-19, as you know, is transmissible, is easily transmitted. So that is why the type of activity, the type of shutdown has had to be much more extensive than any of the other previous diseases that we have been exposed to. And this graph here just illustrates that, so we brought out an infographic just over a week and a half ago, which showed the degree to which countries are shutting down their economies and imposing effectively a state of emergency. And you can see that those that are that have the darkest red are the countries that have imposed a state of emergency and had the strongest restriction on economic and people movement within the country, whereas those in the lighter colors have really only, at that point in time, had only brought in international travel restrictions, the one with the lightest colors, and then everyone else was something in between, doing some type of social distancing measure. But as you can see, even by that time, where there were around 7,000 cases across the continent, you can see that the majority of African countries were acting. But even if you act early, even if you act late, those choices and that balance is, and we've seen in the rest of the world, those choices and that balance is not an easy one. You're either deciding between the high likelihood of job losses with reduced likelihood of high public spending. At the same time, you still have high risk of infection to specific workers, and also this issue around limited source of income especially for poor people at that point in time if you shut down early versus shutting down late, which is, again, none of these decisions are easy. There is no one. I think we are all seeing from the different responses, not just of African countries, but elsewhere around the world in particular, there's no one response which is the right way. So with these two twin effects explained, what does that actually translate to in what the analysis that has been done so far on the impact of COVID-19 on Africa's economy? Well, first of all, it's worth saying that there are effectively 4 key pieces of analysis which have come out, which look at different scenarios of COVID-19 spread across the world, different scenarios of how trade, tourism, and foreign direct investment is affected. And through those scenarios, they then look at the different effects for African countries as well as others. That analysis typically is, again, presented here: World Bank, McKinsey, IMF, the African Union. I should also mention that the UN Economic Commission of Africa has also done some analysis, and UNCTAD has also done some analysis, but we thought we won't confuse everyone with too much. But the overall message from all of them is very clear. The overall message is that African countries are going to go through a very difficult time. The whole world will go through a very difficult time, but African countries will certainly also do so, and more difficult than they have experienced for the last 25 years in particular. So that was the World Bank's analysis just a few days ago, and the IMF just yesterday have reiterated that same finding. It's the lowest growth rate across the continent experienced effectively for a very, very long time. But behind those numbers, it's really important, again, to look at the detail. Before COVID-19 struck, we do know that, again, by these same institutions, so let's just take IMF as an example, 6 of the world's 10 fastest growing countries were expected to be African countries. That included South Sudan, Rwanda, Ethiopia, Cote d'Ivoire. South Africa, I'm afraid, was not on that list, but I think South Africans will understand why more than I would. At the same time, what we have now, if you look at the new analysis from IMF, while the average growth rates have declined, the African countries relative to the rest of the world is actually a very mixed picture. So you find that if you again go back into this sort of detail, 8 of the 10 fastest growing now under these really difficult scenarios are now African. Those are the, again, fastest growing countries in the world. 8 will now be African. So everybody else is effectively will be having a harder time. But nevertheless, that also means African countries will also have a harder time than they expect, than we'd expected and hoped for. But there is still some growth occurring on the continent in particular countries. And the top rate of growth, just again to make that very clear, the top rate of growth in before COVID-19 was expected to be 8.9% in Sudan, and now that's gone down to 4.9%. So you can see that even for the fastest growing country, that rate of growth is halved. So it's absolutely going to be a real challenge. But I just wanted to be very clear that one also has to look down into the numbers to really understand what that effect, those sorts of effects are relative to the rest of the world. So this brings me to since we are expecting a lot of challenges, and of course, Africa is a continent which does have the largest numbers of poor people in the world. So that growth, of course, it might be fast, but it's from a very, very low starting point. And so therefore, it's very important to be able to deal with this issue as quickly as possible. And again, some good news. African governments have been very active. They've, across the board, our analysis suggests that they've brought in almost 100 social and economic measures to deal with the crisis. And that's just within a short space of time. And those measures in particular focus on improved access to essential services, but there's also actions to improve social safety nets. In particular, 15% of the actions are cash transfers to vulnerable groups. There's also income relief a few countries are doing rent and mortgage freezes, this sort of thing. And then many other countries are looking at income protection policies, so how they also support workers. And there's only one African country, Egypt, which has a gender-focused policy. And of course, women often are in the informal sector. Women are often having to look after children as well and manage a range of challenges. So it's important that that ratio is improved and increases going forwards. In our analysis, again, we've looked at which countries are really taking the majority of actions, which ones are performing most, and which ones also have some really interesting ideas and actionable ideas for other countries to learn from. And of course, this is very important, and it's very important for African countries to be sharing their expertise within an African context. It's very important still to discuss with other parts of the world, to look at what other parts of the world, including China, of course, have done, and the sorts of measures that they've brought in, especially because China's on the kind of exit strategy aspect of this COVID-19 crisis. However, it's also equally, if not more important, to also exchange experience within the continent, because different countries have some contexts which are very similar, especially urban environments and cities. So we've listed a number of particularly 6 actionable ideas that come from these top 10 performing countries identified there on that graph, on that map. And I won't go through all of them, and I think what we can do is perhaps discuss some of them as potential strategies going forwards. But I think the key to be aware of is that these are not just, one can't just do cash transfers. That's going to help one part of the economy, but it may not help people who are jobless. One also has to think about informal workers, how they work. And of course, given what's been happening in the rest of the world, there's still massive demand for medical equipment and so on. So how can African countries actually also increase and find jobs through making that medical equipment, masks, sanitizer, etc. And many countries are doing that sort of thing as well. So I'll stop there as a kind of introduction. I think what's very clear as well is the types of countries that are taking action and implementing action are not just the high income, the relatively higher income countries on the continent. They're also the lower income countries. They're also middle income countries. So it isn't just a case of saying, well, the poor countries can't do anything, and they won't do anything. But nevertheless, at the same time, and I think this is a discussion that we're going to have, is there is a role absolutely for further financing. We found that of the 14 countries that have not yet taken comprehensive economic actions so far, they are least developed countries. So 12 out of the 14 are least developed countries, which means, of course, there is some kind of constraint on them, and they must be feeling some kind of constraint that means that they're not actually bringing in these sorts of measures. But as I said, the continent has a huge range of experience and a huge range of actions that it's taking, and that applies across the board, whatever poverty level there is. And that recovery is going to be really crucial to trying to avoid even more people falling into poverty at this stage. Thank you, everyone. I'll leave it there, and let's move to our next speaker.
I'd like to thank Hannah. Thank you very much for this presentation. It was a great presentation, and I certainly, the twin aspect of economic implications as well as COVID-19 implications together, I think will really strike One always ponders about, all these kind of innovations that are also coming about simultaneously, and the hope is that some of that can be amplified going forward. But the inequality that exists, including in South Africa, I mean, just the digital inequality, one component of inequality is just so deep that one wonders, how does one do prioritization when you have these economic challenges together with COVID-19? But I'm sure we'll come back to some of these thoughts later on during the Q&A. So I will take the opportunity to next introduce the next speaker. Admasu Tadesse is an international banker who specialized in trade and development finance, with experience at board and executive levels in Africa and globally. He is currently the president and chief executive of the Eastern and Southern African Trade and Development Bank. He is a recipient of several distinctions and awards and serves on several boards and industry bodies globally. Just recently, Mr. Tadesse has been recognized for his achievements at the prestigious African Banker Awards in June 2019, where he won the African Banker of the Year award. Admasu, we are privileged to have you, and I will now turn to you as a co-host.
Thank you, Chairman, and greetings to all. Pleasure to be on this webinar, and thanks to the organizers for bringing us together to discuss this very critical subject. My commendations to Hannah for an excellent first presentation. She's really set out the context very nicely. And I think we all have a sense of the overall parameters that constitute this very unusual shock, global supply, global demand shock. And of course, speaking from the platform of a DFI, a regional DFI, the question often put to institutions such as us is, what is possible by way of counter-cyclical policy action, both in terms of the sovereigns that we work with and support, but also financial institutions and DFIs in particular. And of course, the whole world is embarked so aggressively on such counter-cyclical policy actions. The last time I took count, the global stimulus in aggregate was counted at about $8 trillion US. I'm sure many of us can think of what the US package was because it's highly reported on. But when you add it all up, mostly from the G7 countries, G20, perhaps in some respects, you're looking at a massive, unprecedented global stimulus. And of course, even airlines, in some cases, are receiving grants of $3, $4, $5 billion. A single airline receiving a grant in that amount. It's spectacular what has managed to come through for both the public and private sector. Now, of course, I'm just laying this out as the context because if the strong economies, advanced economies, let's say, not fast growing, but certainly with a lot of resources and a lot of capacity and a lot of space to respond to this kind of crisis, the question immediately arises, how will the developing world be able to muster the necessary resources to handle their own response? And I think the truth is it's very hard to come up with specific numbers in the same way we've seen the aggregates being reported on for the world. I think at the continental level, I think as Hannah has outlined, there's been a lot of measures being taken, but a lot of these are not easily quantifiable in the same way that the global measures have been quantified. I think the expectation, of course, is that the world will come to the party and do something in the context of the developing world, specifically the African continent. And I think the usual suspects have come through with a number of announcements. And these tend to be mostly DFIs, but global DFIs are typically referred to as IFIs. And it's been a promising start. The IFC announced 8 billion. A big part of that is targeted to Africa, 8 billion US dollars that is. And just about every other multilateral has done the same thing. The reality, of course, is the response on the fiscal side has a foreign currency dimension and a domestic currency dimension. When you examine the fiscal space to respond, and you look at just the macroeconomic framework and the parameters therein, you can see that there is some room for some countries, but it's not a whole lot. So there is a limit to how much fiscal space there is. If you just look at one particular indicator, you would look at the size of the deficit, the fiscal deficit as a proportion of GDP. People who have an economics orientation will know, single digits are okay. You start going above 6%, it starts getting hairy, and you start creating other problems. But typically for a year like this one, people would accept that, fiscal deficits would have to spread and go up. At the current time, the median level is roughly around 3%. Not many people would expect the average level of fiscal deficits in the continent to be around 3%, but this is actually good macroeconomic management. So I think that is a positive thing, but it's not all countries that are in that space, but around 30, 40 of them are. And so there is quite a bit of room to do more of what Hannah has said. Of course, the issue arises as to whether that fiscal capacity or space is mostly in domestic currency respects, or does it involve foreign currency? And then that, of course, raises the big question of debt sustainability and what will be the form of the foreign currency injections, and what character will it have? And I'm sure many of us have been hearing the debates around debt sustainability. It's a long debate in its own right. The key issue there, of course, is if it's going to be concessional finance coming in from soft windows, whether it's the IDA window of the World Bank or the ADF window of the ADB or others, multilaterals like the European Investment Bank, the usual suspects who have very attractive credit terms to offer to countries that are already struggling in some respects to actually sustain their debt service obligations. So I think the low-lying fruit really will be from all the countries that have access to long-term credit that have concessional terms, to exhaust that very quickly and maximize what can be done on that front. And I think we've already seen announcements from these global multilaterals who are very well funded, who have access to G7 country treasuries in all sorts of ways. They've been doing bits and pieces. If you move away from the fiscal space, you come to the monetary space and you say, well, how much room is there on that particular front? And one of the obvious areas would be basically to release monetary, to introduce monetary relaxation in the form of inflation financing or just increasing the supply of money. And we know what that has an impact of doing. When you just take where inflation is at the moment in the continent, again, it's actually a better story than most would think. They're in the single-digit ranges for the large majority of the countries. It's about 8 or so that are in the double-digit range, and just 1 or 2 that are beyond the double digits. And so there is some room for monetary stimulus by of course introducing interest rate reductions, but also relaxing other parameters. I think the big problem will be the country will be the countries that don't have space both on the fiscal side and the monetary side, And there's a few countries like that. And I think the sad thing is some of those countries also happen to be embroiled in political sanctions and the like. So it's not so obvious that, international assistance will flow readily to those countries that need them. Example would be Zimbabwe and Sudan, among others. And so, when you look at the whole environment around financing, there is some very good measures also coming to the continent, but of course, the size of it is limited. African financial institutions, DFIs. You have the African Development Bank, which is another big gorilla that has the G7 countries as their shareholders, and they have capacity to also leverage the resources of those G7 type countries. And of course, their ratings are also very high, AAA rated institutions, so they can issue a bond. And so some of you may have seen the African Development Bank issued a Corona response bond of $3 billion US. And the pricing was quite reasonable. It was 75 basis points, above LIBOR. So it was quite low in terms of the cost of that funding. And of course, that $3 billion now is being made available in the form of liquidity support to sovereigns and other types of counterparties that the African Development Bank would work with. And I would say that's the only African multilateral that has, that type of resourcing to make available in terms of the terms of the credit being long enough and low cost enough not to exacerbate debt sustainability issues. I think for many of the other African development finance institutions, they tend to be market-based in terms of how they raise money, and their ratings typically don't allow for cheap funding to be mobilized. So there's a very big decision that has to be made around prioritization. And so what we have done as TDB is we can do about $1 billion this year of additional financing. If you add guarantees and the like, we can go up to $2 billion possibly. But of course, we raise our funding from markets. Markets are also in a bad place, as many of you will know, even though interest rates have been reduced globally, whether it's the Eurozone or the dollar space. The premiums have gone up and the spreads have gone up. So it's not obvious to everybody that when interest rates go down, the cost of borrowing actually can go up in this type of environment. And especially emerging markets and frontier markets end up having that kind of dynamic. And it's a very unfair world, because you would have thought that when Eurozone interest rates and dollar interest rates get close to zero, you would expect that benefit to be passed on to everybody else, but that's not the case. It's all risk-based. So if you don't happen to be, a G7 type country, your cost of borrowing actually increases. The spreads go up, currencies start to depreciate. You've seen what's happened to the rand in the South African space, but the Kenyan shilling and several other currencies are also under pressure. So I think in the final analysis, what comes out quite strongly to me is clearly whether you're running a sovereign or running a financial institution, you have to focus on priorities. Prioritization becomes very important. So that means there has to be shifting of resources to priority sectors, the medical sector being one, the other one being the commodity space. I think many will know that most African countries don't have well-structured social policies because they're not quite at that level. I mean, of course, South Africa is special. They have a number of special grants, child support grant, disability grant. That's not common in the continent. And I think sometimes what becomes very important is just to ensure that there is security of supply of essential commodities, just to make sure that there's food security at a certain level, in addition to ensuring that the basic services, especially around the medical space, is being looked after. So one of the things we've done is we've said, if there's any kind of request that comes from any sovereign or corporate client that wants to borrow in order to beef up medical infrastructure, to accelerate security of supply of medical equipment or medical consumables, whether they're masks or the disinfectants and the like, we'll give that priority. But of course, the reality is it's still going to be in the form of some debt because it's not a grant. And so the question is, sovereigns have to balance the debt sustainability framework in a particular way. One of the very exciting developments, I must say, has been the call that's been made by the IMF and the World Bank for both the global multilaterals and the bilateral official creditors to introduce a standstill policy for low-income countries, LDC-type countries, many of which are in Africa. And that would have the effect of freeing up resources from debt service to the fiscal envelope, where that funding can be used to help safeguard the livelihoods, invest in the medical sector, health sector, but also ensure that other measures are being financed. So that seems to be getting some traction at the global level. So those countries that have significant debt exposures to global multilaterals, like the ones I've mentioned, but also bilateral official creditors, those who would typically be in the Paris Club of creditors, those are likely cases where we'll see some kind of moratorium, debt relief. There's various language being used to refer to this. It could be reprofiling of debt, rescheduling of debt, many different terms are being used, but in essence, it's forbearance type of lending that would create some breathing room for existing borrowers so that they can actually take a break from servicing debt and channel that capacity into the fiscal envelope so that they can do the things that Hannah and others are saying should be done. So I think there is quite a bit of scope, but for those who are facing primarily commercial creditors, it won't be as easy. So for instance, since University of Johannesburg is in South Africa, when you analyze the debt of South Africa, a lot of it is owned to private creditors, right? So not a whole lot is multilaterals or bilateral official creditors. So the standstill scenario would not have a big impact to South Africa as such, because this very big move to introduce a standstill is focused on official lenders, not commercial private sector lenders. Fortunately, there is a conscience also on the side of the commercial lenders. So you're seeing a number of banks, including in South Africa and elsewhere, who are also introducing moratoriums, offering rescheduling and reprofiling debt. So there's movement happening, but all of these things, of course, require, engagement, requires each entity to be very proactive and to create space for whatever it is that they need to do. So it's not, you won't see blanket measures being taken across the board in all cases. It could happen at the level of IMF and World Bank and the official creditors. That's the call that's been made. That would be a blanket treatment, but the rest would be on a negotiated basis. And so there's a lot of work that needs to be done. It's not straightforward. It requires engagement. It requires managing relationships and being organized about it. So unfortunately, the continent of Africa doesn't have the same easy stimulus package coming through in a big way like we're seeing in the rest of the world. And so it just means we have to work very hard and especially focus on forbearance arrangements with the global creditors, especially on the official front, and then see if the commercial world can follow as much as they can, and also create some breathing room between now and December. It would be very difficult for commercial banks to go beyond a 1-year horizon. It would typically be between 3 to 9 months, year end, and then there would be a review at that point. But engagements like this at various levels are very important to create the goodwill, to create the confidence, to ensure that boards and decision makers don't treat this as business as usual. Unfortunately, ratings agencies tend to be very aggressive, and they focus on liquidity issues. They're not going to take so much comfort in the need for the world to simply just come together and overcome. They investor issues. They work for investors, so they will clearly, cast a very critical eye on the ability of all borrowers, whether they're sovereigns or corporates, to service debt. And the key measures will be deterioration of revenue sources, drying up of cash, and distress coming through various channels, whether it's commodity price collapse, or whether it's tourism flows falling down, FDI dropping, remittances coming down. There's several transmission channels. And unfortunately, this is where those entities that have been prudent during the good years will have a little bit of room to maneuver over the next 6 to 12 months. And as always, when you need the liquidity, it's not so easy to get. If you've built up liquidity and buffers, liquidity buffers in the good years at a cost of course, then at least you have some ability to continue business. We just dispersed 300 million euros to Ugandan government for infrastructure, and we basically made sure there was no interruption in their development finance program, so that construction can continue and the projects that they had planned can continue. And we're doing that with other countries as well. We've done about $400 million in the case of Ethiopia to help ensure that they can continue sourcing inputs for fertilizer, for the food sector, and also import other essential commodities. We're doing the same thing for several other countries this next quarter. So we're active, but of course, it's just not easy because we are LDCs or low-income countries or frontier markets. We don't have our own capital markets. That's where South Africa is lucky. At least a lot of the debt is domestic, and that at least creates more options and less of a squeeze, similar to Japan. But the rest of the continent doesn't have too many capital markets. Those that exist are very shallow and narrow. So a lot of the debt is of a different nature that's not so easy to manage as would have been the case if it's domestic. But maybe the summary would be to say, I think there is very good traction coming through. Clearly, the international community has to come in, whether it's new money or introducing some kind of a holiday to ensure that at least for the next 6 to 12 months, there's moratoriums, so at least governments can, in this environment of reduced revenue, not have to give everything away for debt service, but use some of that funding that was earmarked to debt service for fiscal interventions. So yes, we're watching it. It's an ongoing situation. We all have to keep engaging and sharing notes and pushing the envelope for massive relaxation of debt issues in particular. I think I'll leave it at that, and maybe there can be some interaction back and forth. Thank you, Mr. Chairman.
Thank you very much. That was an interesting presentation, and I particularly appreciated the provisions that are being made both by in-country resources as well as other resourcing options within the continent and also from international. On the other hand, the aspect of debt and how rescheduling or other means can be supportive towards economic recovery. So thank you very much for that insightful presentation.